Welcome to the daily update, where I'll go over the action in the market for Tuesday, February 20th, and we'll see how things look for Wednesday, February 21st. We saw a down day. We are starting to see some weakness develop. Price did fall down below the trend line that we've been keeping an eye on. So far, the 20-period moving average is providing support. We're going to be watching that level to see, are we going to go down below that and then close below it? That would turn things even more negative. But for right now, it looks like we're having a pullback. But each day as we pass, we'll be reevaluating things to see, is this just a pullback or are we starting to shift into a more negative environment? We do have some negative seasonality historically that happens right about now until about the end of February. Then we might see a bit of a bounce, and then that seasonality continues to be weak going into about the middle to latter part of March. And I've been trying to point that out a lot in the videos. It doesn't mean we're going to play out that way tick for tick, but when you take a lot of years together and you look at them in many different ways, this is typically, even during an election year, when it's typically more positive, we do see some weakness during this time. So let's go back and talk about what happened. Right at the open, we had a gap lower open. The futures were not all that active with the holiday session, but then as things started to roll over into Tuesday, we did see some weakness in the futures that carried over into the open. So we had a gap lower open. We fell down below S1. Now we're below 5,000. So we came down to 49.90. We also went down to S2 at 49.75. We did try to rebound back up to S1, but then we went into the close by closing at about S1. So there was a little bit of choppiness later in the day. We were down 0.6%, and this is interesting. Now, it's not really huge, but we were above average, not massively above average. It's been the typical scenario lately that when we have an up day, volume is below average. When we have a down day, volume tends to pick up. That's something that we want to keep an eye on. We are still positive for right now, and it does look like we're going through a pullback. That can shift into a more negative environment. That's what we're going to be watching. And because we're seeing some economic reports that are questioning the current scenario of what's going to happen with the economy, what's going to happen with inflation, what's going to happen with interest rates, and the market is trying to figure out, okay, what are we going to do with all of this? And of course, we want to keep an eye on the geopolitical events. Some comments. We're back below 5,000 with the S&P, and so far the 20-period moving averages are providing support. That's kind of the big level to watch in Wednesday's session. Mega caps, the semiconductors, growth, and small caps all underperformed. These are areas that when they do well, the markets tend to go up. When these areas have some weakness, the market goes down. We will be getting NVIDIA's earnings report in Wednesday's session. I believe it's after the close, so that'll probably have more of an impact on what happens on Thursday. NVIDIA was really down. This is kind of some selling taking place before the earnings report came out. Maybe it's sell the rumor and they'll buy the news if it ends up being positive. I don't play earnings reports like a lot of people do because I think it's a roll of the dice. Even if they come out with a good report, the stock can tank. Even if they come out with a bad report, the stock can really go up. And it's kind of a whole reaction in and of itself that doesn't necessarily tie into what we're seeing in the charts before those reports are released. I know they're really popular with a lot of folks, but you're gambling, in my opinion. And if you're right, you love it. If you're wrong, you don't like it. So, and I don't like to do things that way, but that's my personal opinion. Amazon will be replacing Walgreens in the Dow, so this might help the Dow hold up a little bit better since Amazon's one of the big mega caps and one of the darlings from time to time. Walgreens, which is not as influential as they used to be, they're going to be taken out of the Dow. And this is one reason why we follow the Dow, but I don't base things around the Dow. It's just 30 stocks. And the editors of the Wall Street Journal, they get together periodically. And I'm not just saying they sit around a room and, throw darts to see what stocks they're going to include in the index. They try to do a real representation of the U.S. economy. But it's not a big enough representation. And I know it's what the financial media always reports on. If you're talking about what's the stock market doing, It's usually what is the Dow doing, and then everything else comes after that. But there will be a change taking place with the Dow, so that'll be a little bit of rebalancing that goes on, and it may behave a little bit different now that Amazon's going to be in there, which is another NASDAQ stock. And it was just 20 years ago, 24 years ago, when the Dow first introduced the first NASDAQ stocks into the Dow. I think it was Microsoft and Intel, I believe, were the first introduced. On a short-term basis, we still are looking at an extreme reading with parts of our stochastics chart, which is not really surprising. It takes a while for our longer-term stochastics to really kick into gear. That's why we look at it. We're trying to get a representation across different subdivisions of the short-term time frame. We already have the Stoch RSI, which is extreme negative right now, one of our more touchy indicators. Intermediate term, we're watching the oscillators. And even though I have the PMO listed here, we're kind of watching all of them. They're still extreme positive to a degree, but they're dropping below their moving averages, and they are starting to show some weakness. We still have the Sean trend meter. It came down, but it's right on the border of looking extreme positive. And one thing that's kind of interesting, this actually went off the list. Our 10-day new high, new low study, that was taken off, and now it's being put back on as this has been recalculating. Long term, we're still looking extreme with our 150 and 200 period moving average studies. The parabolic SAR chart is negative, and at least for the foreseeable future, as long as we have a down day, that's going to continue to be negative. This is the basic scenario that we've been going with. It's adjusting and being modified slightly, but I'm trying to give more of a generic version of what the market's dealing with right now, that it does look like the Fed's done raising rates, and they pretty much have said that. And we'll get some more insight into that when the FOMC meeting minutes will be released in Wednesday's session at about 2 p.m. Eastern. And looking forward, the market is really anticipating some rate cuts. It's just a matter of when are those going to start happening. We're still focusing on May. There's still a bit of time that the market has to react to that, and these things can change very quickly. But if that becomes less probable, then they'll be pushing it out down the road. The dollar was down and interest rates were down, which may have helped keep stocks together near the end of the day, especially. Usually when the dollar's going up, that can pressure stocks, and then interest rates have really been going up too, and that will often pressure stocks. We did come down to 4.38% with the 10-year yield, so that did drop down a couple of basis points there. We still have the yield curves that we follow that are inverted. We are dropping now. We're positive with our sentiment, where we had been extreme positive, but the context is a little different now. We were above 75 at the 77 level. We're now coming down as we're seeing some weakness in the market. So even though sentiment is positive, it has more of a negative trend to it for right now. Our trend is still positive, but we're dropping below the moving averages with our ADX in the short and intermediate term, but we're still above 20. So that suggests we are in a trending environment, but it could be a weakening trend. For right now, the green line is still on top, even though they, on both charts, are declining. So we could be seeing a shift at some point in the near future there. With the down day, and we also had the down day in Friday's session, we are negative with the bias, and I'm keeping our momentum. I've actually changed it over to mixed because we still have that kind of positive backdrop a little further back in the trading days, but we're kind of turning more negative right now. So we're mixed to negative with our momentum. The economic reports that came out, we just had one, the LEI, the leading economic indicator or index. It was down 0.4%, more than the 0.3% they had expected it to decline. Last time it was up 0.2%. And here's a chart. The dark blue line, this is the LEI, where it has been coming down, and now it is on a year-over-year basis showing some improvement. Now, when you talk to folks who think we're going to go into a recession, this is one of the first things they cite as evidence. When this is really falling, this is leading. This is what's supposed to happen into the future. And with this coming down and giving us a very low reading, this is often what is cited to say, yeah, things are not looking very good. We're going to go into a recession. On the other hand, the fact that this is starting to turn back up is showing that there's some improvement. We also plot it with GDP on here, which still remains above zero. because a definition of a recession is when real GDP, that takes inflation into account, is negative for 2 consecutive quarters. And it's not doing that, at least yet. Some other charts from Isabel Net. This is showing the insider transactions ratio. Now, these are legal insider transactions. And periodically, I like to explain there's an illegal kind of insider transactions. If you saw the first Wall Street movie with Charlie Sheen, that's illegal. That's why he went to prison. Legal insider transactions, that's corporate officers, owners, CEOs, people that are very influential. They can buy and sell shares of their own stock. And we were getting up to a really high reading, which tends to be really negative for the market. Now we're coming down and we're more in the neutral area. But if we drop a little bit more, that could actually turn into a bullish signal. Now, there's a lot of problems with this. From the time these insiders buy or sell, there's a real lag from the time they do it until it's reported. And a lot of people base their decisions on these kinds of things. I never really have, because you're dealing with old news at this point. All right, then we're looking at the equal weight S&P, and here's the forward-looking PE ratio, which is a little above the 15 level. With the PE ratio, we use the 10, 15, and 20 as static numbers. So we are not necessarily overpriced with the equal weight index, but we're still above that 15 level, where if you take the S&P together, we're actually a little bit above 20 right now is where I came out with the last figure. So that has to do with mainly the mega caps and these high PE ratio companies that are making the PE ratio for the whole S&P 500 more expensive than if you look at the equal weight S&P 500. And then these are the rate cuts that the market is anticipating. And it says the markets are pricing in, I don't know how you get 3.5 rate cuts. Okay, I'm the Fed. We're going to do half a rate cut right now. How do you do that? It's kind of like being sort of pregnant. But anyway, from a statistical standpoint, the market is starting to price in the idea that the Fed is going to be cutting rates in 2024. Then this I wanted to bring up just because we're keeping an eye on the banks, specifically the small banks as well as regional banks. If you notice this column right here, they have a lot of commercial property loans. And if you keep up on what's happening in commercial real estate, there's some real problems there. After all the lockdowns, you have companies that are saying, you need to come back to work. And people are like, nah, I kind of like working from home. And so you have all these business buildings that are not really being occupied as heavily as they were before we had all of the lockdowns. And when they went to buy these buildings, they went to more smaller banks to get those loans. And if people are trying to, readjust things based on interest rates going up and occupancy levels and so forth, that could put some real pressure on the smaller banks. So we just want to be aware of that. Here's our intraday chart where we did gap lower down below S1. We came down to S2, eventually fell down below that. We came right down here. This is the 20-period moving average. That's about where we found some support. So for right now, that level is holding, and we were able to come up off of that and close right about at S2. Then here's the intraday chart. We were showing a little bit of weakness as we closed from Friday. Then we had the whole 3-day weekend. We picked up being more negative in the initial pre-market session, and then we went negative during the cash session, and we're not showing an awful lot of change in the initial overnight session as the market gets ready to open for Wednesday. We are declining when we look at the red line and the blue line, but the blue line is underneath, showing that growth is underperforming. This, and I fail to point this out sometimes, this is a 10-minute intraday chart. And I did a what to watch video, and I forgot to point that out, where a lot of people might think that this is an end of day chart, but no, it's an intraday chart. And it's showing a little bit more weakness with the blue line under the red line. So this is an area that we're keeping an eye on here. We are seeing the growth to value ratio also with another 10-minute intraday chart. This is starting to show some more weakness. Yeah, we saw a little bit of a bounce later in the day, and that's encouraging. But if you go from about, February 9th or so, we've been showing more of a decline as we've been moving forward and heading more into this weaker part of seasonality. Here's our end of day chart where growth was down. Value for the large caps was actually up. It was down more for the mid caps, and they were about even, but down a little bit more for the small caps. So some of the strength that we have been seeing with our growth to value ratios, that's starting to turn a little bit weaker now. We are coming back down with the small cap growth to value ratio after we had been breaking out. As we were breaking out, I was trying to point out, yeah, this is pretty positive, but the fact that this is coming down, we want to keep an eye on that. We're also seeing a bit of a pullback here with mid-cap growth to value, where it showed a bit of a decline in Tuesday's session. We're also coming back down after looking more positive with the S&P growth to value ratio. If this continues to go down, that would be likely more negative for the markets. We're also keeping an eye on the discretionary and staples ratio, where it is showing some weakness after it had been improving here. And if this also continues to come down, that could be more negative for the market. Looking at our trend, we're still below the moving average. The green line's still on top, although it is declining. We're still above 20. A weakening trend because we're below the moving average, but it still is a trend since we're above 20 and it's still positive with the green line on top. We're seeing pretty much that same thing with our short-term ADX. We are dropping off a little bit when we take the last number of days together with volume, where we had another down day. We did turn up just a little bit since we were slightly above average with volume. Here's the more aggregate chart that we look at about once a week. This takes the AAII, individual investors, the bullish percent indexes, the put call ratio, the active asset managers, and the VIX, and puts them all together. Now, this is over the weekend, so this is still getting an extreme reading over here where we're starting to see this come down a little bit more into the yellow area based on what we look at. The Ulcer Index is really not moving all that much right now. We did see a move up with the VIX when we look at the line chart as well as the bar chart, as we saw some declines. We're seeing a bit of a pickup in volatility with the VIX moving back above the moving averages. This is a newer chart. I've been using this for a long time, but I haven't been including it in the videos since we could potentially be entering a period of weakness here. This measures the momentum of the VIX itself by using the MACD. When this is going up, that means that overall the VIX is going back up. When the VIX is going up, that's typically negative for the market. Then the equity put call ratio did tick back up on the daily chart. We're starting to tick back up here with our 5 period. That's more negative. And we're still keeping an eye on our VIX to S&P 500 correlation. We're still extreme. We haven't necessarily topped out yet. This could still go higher. Once we do top out and start to come down, that is usually negative for the market if you compare it with other times that I've marked on this chart. So as long as we're still going up, it's still getting ready to do something. It's when it really starts to drop, that's when we'll pay attention. The SKU index has dropped out of this red area. So the market had been anticipating some kind of a big move. We did get a move down in Tuesday's session, so that might be what the market has been anticipating. And this will be updated here pretty soon. This is almost a week old now. This is Investors Intelligence showing that sentiment is still extreme positive. Once this gets updated, we'll get the new reading for this. And I want to address this again. I've been talking about the Hindenburg-Ullman. I'm not a big believer in it. It's only been correct about 25% of the time. I did some more research on it over the weekend, and actually I have a chart to show you here because there's a lot of perma bears out there who just love this thing, and they're going to present it to you as fact, and they're going to present it to you as this is the only scenario you need to worry about. Where my approach to this whole thing is you don't just use one chart. You don't use one thing that you're seeing in the market. You take everything together to reach a consensus as to what your current evaluation is of the market. And that's my big complaint about people that seem to uncover something that, oh, nobody's talking about this, or I found something that is unique and the market's going to just magically follow along with that. And it ends up being bogus because we need to pay attention to what the market pays attention to, even if there's some inconsistencies, even if there's some shortcomings, like in the economic reports that we get and some of the things that are released through the financial media. Okay, yeah, we realize that we're not always being told the absolute truth, but at the same time, that's what the market pays attention to, and that's what the market reacts to. And so one of those things is the Hindenburg-Omen. And I have been bringing this up. And over here on the left, this is how the thing is actually calculated. And it, based on the research that I did after this first came out, and then based on Investopedia, it's only right about 25% of the time. So that's not good enough to me. If I do use this, I use it in conjunction with other charts. Now, I did go ahead and create a chart. I found that stockcharts.com takes these different parts here. They use a rate of change for the NYSE. They go with this 2.8% highs, lows at the same time. That means churning's going on in the market, and also the McClellan oscillator. And they came up with their own little indicator here, which puts all of these things together into one signal. And that can be kind of useful. So I'm going to keep an eye on this chart. And when we spike up the way it is right now, that's the warning sign number one. Now, what we need to watch for is another signal within the next 20 trading days, which is roughly a month. So if we see another spike up, then that will be a valid Hindenburg omen. And there are times when this was okay. I mean, back in 2019, we had a number of signals generated here. Didn't see a massive drop off, but it was a decline nonetheless. Right here, right before the COVID plunge, we did see a Hindenburg omen. And of course, all the perm bears are patting themselves on the back and having a party saying, oh, I told you all about this, and look what happened after that. Okay, fine. If you want to do it that way, that's okay. We also had another Hindenburg omen right at the end of 2021, going into the early part of 2022, before we saw a very difficult year in 2022. So there's some validity to this, but we've got to take out these single spikes, because some of them are erroneous, and we use other charts also to kind of make our conclusions for what's happening here. All right, there's my thing on that. Looking at our advanced decline line, we did decline based on price and volume, but we're still holding up for right now. We're turning back up with our new highs, new lows. We're seeing more new highs than we are new lows. We're also trying to go back up here with the 10 period. We're still above the 0 level with the advanced decline ratio, even though it did decline. Accumulation distribution is ticking down and coming back closer to the moving average, but for right now, it's still positive. We are showing a little bit of weakness, but we're still positive with the Chaikin money flow. We're no longer extreme with the Chaikin oscillator, and we're still positive because we're above 0, but we are declining now. Looking at our advanced decline line studies, we did show a little bit of weakness with the NYSE common stock, the S&P, the mid caps, the small caps, which are coming a little bit closer to their moving average. Here's our daily chart. You can't really see it all that well here, but we have dropped below this trend line. On the bottom, we did tick up above the average that we've been seeing for volume. Here's the Stochk RSI, which is extreme negative already. Here's the 20-period moving average. So, and I'll show you the trend line chart here in just a moment. But this level so far has been providing support. We ran into some problems early in 2024, and the 20-period moving averages held. Later on, we hit that a couple of times. Last week, we hit it again. Now we're dealing with that. Are we going to bounce up off of that? If we look to not only go down below it, but close below it, that could turn things more negative. We did see a bit of a decline with our 20/50, and we're pretty much flat with our 200-period moving average study. We did decline with the force index, but we're still positive. We're no longer extreme in the short term with our stochastics, turning back down and no longer extreme in the intermediate term. We are declining, but still extreme in the long short-term stochastics. We're not extreme here with the standard deviations chart. We're still above the midpoint, so that gives us more of a positive flare. If we drop below the midpoint, that will turn things more negative. Here's the 20-period simple moving average of the open, high, low, close. Right now, we are seeing some support in this little mini rainbow. This is not my study. This is put out by Carl Swenlin, who developed a site called decisionpoint.com years ago. Now it's pretty much been taken over. I think his daughter runs it now. And a lot of the indicators that I use came from decisionpoint.com. He then had, for a while anyway, some kind of an agreement with stockcharts.com, and they used to share information. Well, when I talk about a golden cross, that's really, at least from him, it could have come from anywhere, but When the 50 period moves above the 200 period, that's called the golden cross. Well, we also have what's called the silver cross, and that's when the 20 period moves below the 50 period. And it was really him that I attribute to making this more presentable in a technical analysis way, where this is the silver cross index, and we're starting to see some weakness here with the 20 period showing more weakness when compared to the 50 period, even though the S&P has been going up. We're pretty much flat right now when we look at the golden cross index, but then we're seeing another negative divergence here when we look at the stocks above their 20, 50, and 200-day moving averages. So I try to present this information my own way. Like I said, this chart was not developed by me. I took this from an email that he sent out, but this just suggests some of the negative divergences that we're seeing. You might want to pause this. This just tells you what the definition of a golden cross is and what a silver cross is here. Intermediate term, we are declining, but we're still positive with the balance of power. We are still positive with the darker blue bars with the go, no-go system. We're still above the midpoint with our highest high value chart. We are positive, but turning darker blue with the TTM squeeze. So this is showing some weakness. We are declining, but still above zero with the ease of movement. We're flat with the Erin indicator. We're dropping below zero with the McClellan oscillator for the S&P. So we're starting to turn back down based on price, and we've already started to turn back down based on volume. We're just about at the 0 point. We're just barely positive with the NYSE McClellan oscillator. So we're still going up with the summation index based on price and volume. So the broader market for right now is holding up a little better. We are declining, but still above zero with the Swenlin trading. This is Carl Swenlin. He developed that, the decision point site that I referred to. We're still positive based on price, but we are declining where we're dropping below zero based on volume. And here's the PMO, another indicator that Carl Swenlin developed, where we're still extreme positive, but we're dropping below the moving average. We're a little bit positive here based on price. We're still right on top of the moving average based on volume. So we saw a bit of a decline with the PMOs that are rising. We're flat to slightly increasing with the buy signals, and we're flattening out a little bit with the PMOs above zero. Where we continue to be neutral with the Elder's Impulse system when looking at the S&P. We're still negative with the parabolic SAR with the dots on top. The slope oscillator is below its moving average and declining, but it's still extreme positive. The MACD is dropping below its moving average, and you could see here a negative divergence from the high that we set in late 2023. The S&P went up, and we made a lower high with the MACD. But again, as I like to point out, these are moving average based oscillators, so you can't help but have a negative divergence. It ends up being more of a self-fulfilling prophecy. So looking at all of our oscillators, we're now declining but still extreme positive with the slope and the TSI. We're rolling over with the MACD, the PMO, and the PPO. We're starting to come down with our long-term oscillators, the TRIX and the KST. So we're seeing some more negativity when we look at momentum across different time frames. But here is the 20-period moving average that for right now continues to hold. We did decline with the bullish percent index with the S&P, and we're below 70. So once we drop below, that's an official sell signal. As we continue to go down, that is more of a confirmation of that. But we're still positive with the NYSE bullish percent index. We're chopping around here, but we're still above 50. And we dropped off, and we're no longer extreme positive with the NASDAQ 100 bullish percent index. So that's another sell signal. The money flow is declining, but still above 50. The ultimate oscillator also declining and above 50. The green line is on top with the vortex, but it is declining, and the red line starting to come back up. We are declining, but still positive with the RSI based on 14 and 9 periods. We tick down with the unbalanced volume, but we're still above the advancing moving average. And we're still seeing this longer-term negative divergence with our 200 periods moving average steady with those stocks that make up the S&P. We were going up with the index. This was not making a higher high. We were also seeing that negative divergence when looking at the 50-period moving average steady. The copy curve has already changed over negative, and showing the momentum is negative with that. We are coming down with the Sean trend meter after being extreme positive. And we're turning a little bit more negative with the Heikin Ashi. We have the black candle. We're still positive with the Kegi, but now we're back to pointing down. The Renko chart is still looking positive. The 3-line break is still looking positive. So we're seeing some contradiction here, some different signals. Long term, we have dropped below this trend line. And now we'll have to see if we have an up day, are we going to be able to get back above this trend line? So this first line of support has been broken. Now we're going to start focusing on the 20 period moving averages, but we're still extreme positive with our 150 and 200-day moving averages. Looking at the Keller market model, we've dropped, but not enough to really change things, at least yet. When we look at the S&P, mid caps, small caps, and NASDAQ 100, here are the alerts that were triggered in Tuesday's session. Most of them were negative, so we're seeing an awful lot of red. And the red line did come down, but it actually held up a little bit better with the equal weight outperforming the S&P 500. So we're seeing the ratio coming down just a little bit here as the mega caps underperformed. The Dow's still chopping around. It was positive. It was, at least when I was watching, it was the last major index to go negative. There was some positive news coming out that had to do with earnings, but eventually it rolled over and went negative as well. We continue to be neutral with the diamonds when looking at the Elder's Impulse system. We are showing some weakness, but we closed up well off of the lows with the NASDAQ. But now we're back below this pivot level at R1. We're also showing some weakness, but closed in the upper part of the bar for the NASDAQ 100, so well off of the lows. But we switched over to negative with the QQQs with the Elder's Impulse system. The momentum for the NASDAQ 100 is now turning more decisively negative. The small caps, yeah, kind of as we feared, they were going back up. Now they're starting to pull down. They're still above the 50-day moving average when looking at the small cap index. And we switched over to neutral with the Elder's Impulse system for the small caps. Here's the Russell 2000 small caps. We're still above 50 with the RSI, but we are declining. We're still above this support level here that we seem to have an awful time to stay above. We're still above the 50-day moving average. The momentum is positive, but it is rolling over. The mid caps also still above this R1 level, even though they declined, and they remain neutral with the Elder's Impulse system for the mid caps. We did have a down day with the FANG index and still coming off of all-time highs. The financial sector was also down, but is still in a pretty solid uptrend. Keeping an eye on New York Community Bank, it was down a little bit over 4% as it's seeing more weakness. The dollar ended up being down slightly. I know that says plus here because it continues after the market closes. But this could be getting close to an uptrend at some point if we stay above both of these moving averages, and that could put some pressure on stocks. Here's bonds where we were down slightly with the 10-year yield. We were up slightly with the 10-year based on price. And then looking at our growth to value, the Qs are starting to fall below the moving average when compared to the S&P. Discretionary still is having a hard time getting above the moving average, and the moving average is declining. We're dropping below the moving average when we look at large cap growth versus large cap value. So we're seeing some weakness with the large caps, mid caps, and we're still above the moving average with the small caps, but there was some weakness in Tuesday's session. We're still positive with the 5-period moving average of the highs minus the lows, and we measure that across the Amex, NASDAQ, and NYSE. We came back above this green line here. We dropped below, but now with our 10-day average of the S&P 500 highs minus the lows, we're starting to get extreme positive again as it's going back and picking up what it wants to use as part of its calculation. So what's our outlook for Wednesday? We're still positive now, but we are seeing some signs of weakness, and we're also coming into an historically weak period of seasonality. We're going to get the MBA Mortgage Applications Index. The big one is going to be the meeting minutes from the FOMC that'll be coming out at 2 p.m. Eastern. And then we just want to watch the geopolitical events that are happening here. We're going to get weekly jobless claims in Thursday's session and existing home sales. And we're not going to have any reports in Friday's session. Here's some seasonality. Just for February 21st, we are negative across the board. And we also have Wednesday, which tends to be the most negative day of the week. We also are entering the latter part of February, which also is historically weak. This takes it in a bigger context where we see some weakness that could go to the middle to latter part of March before we see some strength going forward. We also are entering that time when we see some weak seasonality according to the Stock Traders Almanac. Also some seasonal weakness here. when we get to the middle part of February into the mid to latter part of March, when the current president is running for re-election. February tends to be the worst of the best 6 months, even during an election year. Wednesday tends to be the most negative day of the week. We do see a little bit of negativity here with the green dashed line during an election year for the S&P. But look at these lines overall. This is also showing going into the latter part of February that we do see some seasonal weakness pretty much from here on out for the month. And then Tom Bowley also is showing that weakness in the latter part of February. So our scenarios, can't really go with the down one yet. We're still positive. We could be shifting, but we're not seeing really any confirmation of that yet. Although we are in that period of weak seasonality. If anything, we go with the upward scenario, but only if we have an up day. If we're still looking positive and we end up closing down, according to the way I do things, I would not enter any new long positions. We're not going with the sideways trend because we are still in a trending environment. So volume has been decreasing when the S&P has been moving higher. That's a warning sign. It seems to pick up when we're going down. The risk on posture is not helping us. Our 5-period equity put call ratio is going up. Our oscillators are still extreme, but they're dropping below their moving averages, and we're starting to see some negative divergences. We're also seeing negative divergences with the McClellan oscillators as well as the summation indexes. The parabolic SAR is negative. The Copic curve is negative. The NASDAQ 100 bullish percent index is now dropped back below 70. That's negative. Momentum for the NASDAQ 100 is also negative. Small and mid-cap growth continue to negatively diverge from the S&P. Discretionary is negatively diverging from the S&P as well. The transports are negatively diverging from the Dow and the S&P. Do you see a theme here? We're seeing a lot of negative divergences. And stocks are entering this period of historical weakness. All right, positive signs. For right now, growth hasn't fallen apart, at least yet. Now, that could change, and it is showing some weakness, but it isn't just going off a cliff, at least yet. Our oscillators are starting to show some decline. So that's why they're both on the warning slide and on the positive side, even though they're still positive here. The vortex is still positive, but showing some weakness. Small and mid-cap growth is still hanging in there for right now. The financial sector was down, but it's still positive. So our conclusion, we're positive, showing some weakness. We're entering that period of weak seasonality. That's what we're watching in the short term. We're also looking at some possible weakness developing in the intermediate term. We're still positive in the long term, and we're still overbought in the long term with our longer term moving averages, but we'll be keeping an eye on that as well. Thank you. I really hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.